All right, so like Mark just said, I lead our enterprise research team here at Messari, and we're going to be talking about the big trends going on in crypto. So let's just jump right on into it. Number one, we got maturing collateral within DeFi. This is really important because we really get away from that kind of volatile collateral that underpins a lot of kind of historical DeFi. So just in the last year, within the last 9 months, we've added over $500 million of on-chain treasuries. The number's about $600 million right now. You're earning about 5% on an annual basis. That doesn't really even include the biggest player in the RWA space, which is MakerDAO. MakerDAO bought $2.6 billion of RWAs in the last year. That makes up over 50% of their assets, 60% of their revenue, and $100 million of annualized revenue. Like, that's a hell of a business. This is completely changing and underpinning what Maker's business model is, okay? They're making real money on their collateral versus sort of the LPs making that money, all right? So really, what is the magic of this collateral? Why is it more efficient? Why is it more, just a better for DeFi overall? It's just because it's earning yield, okay? And RWAs isn't just the only yield source out there, okay? We got it within DeFi as well. ST-ETH is, of course, staked Ethereum that's earning yield just from block emissions, okay? So ST-ETH is in Aave right now is now the largest collateral asset at 33%, 1.2 billion. That's all in the last year. They didn't even have this as a collateral option the year before. So what does this all really mean for DeFi, right? It's, again, this efficiency, opportunity cost. If you're holding capital, you want to take out leverage, whatever it is, you're looking at a decision before this of, hey, do I go earn yield over here, or do I deposit as the unyield-bearing asset? Well, with this sort of structure, it's a lot more efficient, a lot more scalable, and really unlocks new business models. So within DeFi, we're seeing call it a maturing of business models out there, okay? And historically, DeFi business models kind of suck, right? I mean, like, this is just DEX fee efficiency over the since DeFi summer, okay? Straight line down, fee efficiency's down 50%. Why? It's too competitive, right? It's open source, anybody can copy it. How do you build moats if anybody can copy your code and just deploy it, launch a token, put some incentives on it? It's really hard to keep and justify charging a fee. But this is not all DeFi business models. This is net income with relative TVL. So just to think of that as like a measure of scale of your business. Top right, you're at scale, you're making money. Further left and further down, you're losing money, you can't scale your business. So the two protocols on the top right, Maker and Lido, what do? Why are they up there? Why are they making money? And why can they charge fees? It's because they have what I call liquidity network effects, okay? Lido and Maker both issue assets, and that assets is spread across DeFi. It's used, it's in people's wallets, it's accepted in money market protocols, you name it. You can't just fork Maker's code, you can't fork Lido's code and just magically print $4 billion of stablecoins, okay? That's not how that works. So that's a moat, that's a defensible moat. We already kind of went over Maker, how they're making their money. Now further left, we've got Uniswap, Balancer, PancakeSwap, you name it. Great protocols, shitty businesses, okay? They can't really charge a strong fee. But that's changing. Over the last year, Aave and Curve have both launched stablecoins. What this allows them to do is basically take the fee that they would be taking from LPs, which is the number one dimension that you compete on as a DeFi protocol. That's now a capital cost, and they're making money just from the interest earned on the stablecoin and allows them to scale the other side of their business. So it takes the revenue burden away from the, call it services side of the business, and puts it into this singular model. Maker's doing the same thing. They kind of launched their own money market protocol. And this is kind of where the top DeFi protocols are going. So just over the last 3 months, Curve USDs makes up 36% of Curve's bottom line revenue. That's a significant chunk of your revenue mix, all within 3 months of changing, okay? And that number is going to keep growing as we keep scaling the half of the business. So sort of staying on the real world integration theme, crypto is becoming more real, okay? Visa's building out payment rails, and this is really, really important that Visa's doing this because the merchant acquiring side is heavily important. You can't just convince, launch Solana Pay, for example, and just expect everyone's going to use it. You need to have businesses able to accept that. That's what Visa has. They've got this starting to integrate into their network. They just did a POC on top of Solana. They've got stuff with Ethereum, partners with WorldPay, et cetera. Additionally, Gnosis Pay is the largest, wallet out there. They have $52 billion of assets stored, 4.4 million or 4.4 million safe accounts. Okay, this is huge, and they've got a Visa debit card launching. It's going to be in Europe first. This really makes what crypto feel real. Okay, if you're earning money within crypto, you can go buy coffee with it. This is like a huge step function from a UX perspective, where people can actually feel like this isn't just a toy off to the side. Okay. And really what that matters is more for the consumers. The consumers are, like, crypto's always been a bottoms-up function. So if they're making money, if they can use and pay for that, that makes crypto feel real. But we got to be able to build consumer apps, and that takes infrastructure, okay? That takes devs being able to pull stuff together and build something that you want to use and are like okay using. That's wallet infrastructure, that is payments, that's on-ramps, off-ramps, everything that kind of comes together and makes you build a UX that you can actually like use and not like, you know, complain about, okay? It's happening right now. This is a hugely growing thing. So just take FinTech, for example. FinTech has grown $30 million in TVL, about 200,000 users, kind of in the last couple weeks. So just take September's revenue, this FinTech's got. It is larger than Curve, Balancer, Aave, Compound, DYDX, GMX, all put together. I just rattled off about $3 billion of market capitalization that this protocol is earning more revenue of. Why? Because they were able to put together all this sort of wallet infrastructure, embedded keys, et cetera. And so basically just argument is consumer apps are basically here. We can build them. It's going to happen. It's getting better. And this is all happening because we've got base layer scaling infrastructure. You can't build consumer apps if you're paying $15 a transaction. That's not how that works. You can't pay $5 whatever dollars for a social post. It's got to feel real, internet-like, right? So this is just taking L2 transactions over top of Ethereum transactions. Over the last year, we've sort of more than doubled the transaction ratio. This is adding up base, Arbitrum, and Optimism, by the way. That's a 7x growth year over year on that transaction ratio, 13%. This number is straight top and the right. It's going to keep growing and growing because this is only 3 L2s, okay? There's more L2s coming. This is a modular landscape out there where people are able to spin up their own roll-ups. Lower transaction costs are coming. We've got daily availability layers launching. Celestia is going to launch probably in this year. Eigenlayer, et cetera. This is going to make the transaction cost significantly lower than it is right now, and for far greater use cases. Why is that important? That if you think of that transaction cost as the baseline unit cost of, call it, doing crypto, okay? This is, if you can, like I said, like for consumer apps, you need this, right? For gaming, you need this. It's happening, it's growing. You can see, this isn't everybody, by the way. This is one of the most fastest growing, heavily invested sectors out there. But if you also really think about what these applications doing from an L2 perspective, what you're trying to basically just do is run some computers off-chain, do some computations just so we can have lower transaction costs. But just proving a chain or proving or running some transaction sequencing is one aspect. How do you build feature-rich applications? You need to have more complex compute, right? You got to build something that is not just a simple swap app, okay? In order to do that, you need to run computation off-chain that's not on an AWS server, basically. So ZK co-processing is going to be a big trend, probably more in 2024. This is going to allow you to run arbitrary compute, whatever it is, what are your application logic, off-chain, prove it, send it on-chain, and use that within your smart contract logic. So you can think of things like LLMs, running that off-chain, proving the execution down to the smart contract layer. This really expands the application set. We're so used within crypto where we've been indoctrinated to like very limited, very basic applications, almost frustratingly so, right? This is going to greatly almost re-architect how we do applications within crypto, and it's going to open up a really exciting time. So we've got talks on like this throughout the day, throughout the week, and it's really going to open up what I would say the application side. We're really shifting away. We've invested a lot in infrastructure over the last year. We're going to see a big boom and more experimentation in the app layer in the year to come. So thank you, and enjoy the rest of the talks.